This is our second episode of Real Estate Rap Sesh. I got here with me Chris Ruiz from Supreme Lending.
Yeah, Chris Ruiz out of the Walnut Creek office for Supreme Lending, the best mortgage broker in town, in the Bay Area. Everything from down payment assistance to 5% jumbo, as low as 620 FICO scores. And we're able to do all of that internally with 15-day closes. So that's our claim to fame.
The first step to buying a home is to get pre-approved.
Correct. What I think we see nowadays in our real estate community for lenders and agents is that typically first-time buyers or just buyers in general don't start this way, right? It's the reverse process. They find the house first and get excited and jumped out of their seats and honey, stop the car, and then realize that they may not be approved for that amount, or they may not know what they're really getting into as far as payment. But you're absolutely right. The first stage of the game is knowing your numbers, knowing where the current interest rates are at, knowing which programs are out there, what fits best for your situation, but understanding your numbers and then being educated to go out there and have an agent that's not only professional, but knows the market and is a negotiating expert, and that can definitely get you the best deal.
If I have someone that's interested in buying, they call me and they say, hey, I'm thinking about buying a house. Here's Chris's number. How's it go from there?
Me as a lender would do their initial introduction, reach out and say, hey, this is Chris from Supreme Lending. James referred you over to me. Hey, I heard you want to buy a house. Congrats. Let's talk about some numbers. And we do what we call an initial introduction interview over the phone and get an idea about their scenario. And within that time frame, a good lender will be able to let you know, hey, I already have a few options for you. Here's what I'm thinking. This is the next step. And then documentation is required. This is the part that gets always interesting for us lenders, is when we send out a list that's needed for a purchase. We need a bunch of stuff, and that's nothing against the buyer. Some folks, they think that it's personal. Lending has changed, as you know, James, since 2007's crisis. The underwriting guidelines have tightened up, but nonetheless, every buyer is going to need 2 years tax returns, most recent 2 years, 2 years W-2s, 2 months bank statements, most recent, 2 most recent pay stubs, copy your driver's license, and an online completed application is what we prefer.
So there's people out there that come to me a little nervous about the whole process because it is the largest purchase that someone will probably ever make.
Yeah.
And so sometimes they get a little weary about having their credit checked. They think that people can be pushy. What would you say for some of those people that just want information to see if they're on the right track?
We've gotten pretty good at our office where we can offer this option as an alternative especially for millennials like us that are very distrusting and what have you, and not too sure about, if it's the right move right now. Do you really want to see that inquiry on your credit report? Totally get it. Totally cognizant of the fact that we want to make our credit as polished as possible. But we can do something called an initial overview of that person's application without a credit pull. This does not mean you're pre-approved. This does not mean that you've been pre-underwritten. You've not been pre-qualified, really, because we don't have a credit report. We're just going off of your income statements that you share with us, your income documentation. I'd like to see a credit report from like Credit Karma or something like that, just to kind of know where your scores in the ballpark range are at. I know those scores aren't going to be the same as my FICO scores because it's a different scoring system in general, but it'll let me know that you're at least above the threshold for conventional or FHA. And then with that, I can give them a ballpark scenario. Hey, if you did want to move forward, here's where your payment would look like, assuming that your scores do come out like this. And it gives them an idea. It opens up options. And it lets them know, oh, wow, I could actually afford it. I was thinking when I was running the calculation online on this calculator, I would only be approved for this. You're telling me I can be approved for this? Wow, let's go talk to James now.
What is the actual name for it that buyers should be looking for to have and be able to put an offer in?
They should be looking for a pre-approval. And if you want to be even more on top of your game as a buyer, ask your lender, okay, once they've submitted you a pre-approval letter and you have that in writing, I would even go one step further and ask your lender, hey, may I have a copy of my desktop underwriter approval? What that does, that's an internal Fannie Mae system that all lenders have access to. And if you've been truly pre-approved, they'll run your application through that scenario, and within 30 to 60 seconds, it kicks us out an approve eligible or a refer ineligible. And that'll let you know that you've been truly approved, or they're winging it and they're trying to figure out some other scenario to get you approved.
Well, what is going to affect what they can buy and how much they can afford?
The biggest ones I would look at is your debt. If you don't have any debt, wonderful, you're ready to go. You'll have an easy time in underwriting. It's hopefully that you have some trade lines in place like credit cards, things like that are paid down to zero. But what you would want to look at is that your income is stable, and they want to look at the credit. They want to see how much history. And a tip for a lot of my first-time buyers out there that maybe are just really early on in their life thinking about buying in the next few years, have 3 different types of trade lines. Trade line would be considered a credit card, a student loan, a car loan, and that you've had these trade lines for 24 months. It will give you a strong sense of credit history when you start to apply for a mortgage. Secondly, with regards to your debt situation, to go back on that scenario, being able to go ahead and try to limit that before you're ready to talk to a lender, if you can, that would be helpful. So if your credit cards are high on balances, just know that that's going to give you a lower score. If you can pay those cards down below 30% ideally, I even tell folks if you can get it below 20%, 15%, it's more better when you pull your credit, because then we're going to be able to see those numbers. I would look for that, and I would definitely look at saving if you haven't already saved. If you already have a down payment, great. If not, saving for that for sure. Setting up some type of goal, some type of delayed gratification to get your savings up so you can have a nice down payment.
So speaking of down payment, what do they need?
It really depends on their goals. It depends on what area they're looking to buy into. Most folks are still under the impression that they have to have 20% down. That's just not true anymore. There's for first-time buyer programs out there as low as 3% down, 3.5% for FHA. You can do 5%. The most common that I see in the local East Bay area is the hotspot of down payment is around 8 to 10%, believe it or not. So if you think about 8 to 10% of a $500,000 purchase price, it's about 50 grand. And if folks don't have that, they may even consider looking at down payment assistance options. There's a plethora of different programs that are out there in the state of California to help with that, so folks can go ahead and not have to, break the bank, or maybe not have to scramble for gifts from family and friends, and they can have a lender that can provide that, assuming they can qualify for it.
I think that there's a misconception that you have to be a first-time home buyer in order to get certain programs. What are some that you see frequently that your buyers or your borrowers take advantage of?
The most two common that I see is the CalHFA program. That's the California Housing Finance Agency, and you can look that up at calhfa.com. Or you can look at the GSFA program, the Golden State Finance Agency program. Those two, you do not have to be a first-time buyer. So that opens the door up right away. Both have the minimum credit scores of 640 to get into, and I believe GSFA is much more higher in income. You can actually go up to like 100. You can make about $180,000 and still qualify for that program.
So talking about income too, I think that there's another misconception about how much money you need to make in order to buy a home. But what do you see in terms of your borrowers? Do you need to make $100,000 a year in order to buy in the Bay Area, or have you seen differently? Good question.
It really depends on that debt scenario that we had talked about earlier. You might have somebody who makes $50,000 a year, but they've got zero debt, versus somebody who's making $100,000 a year, but has $2,500 in revolving payments between 2 car loans and student loan and what have you. It really depends on that debt scenario, and that's where having your numbers ran by a lender as far as financials would be the most smartest move to make. So that way you can understand that, hey, what can I truly afford? The ideal number that most folks would like to stay under is what we call 30% of your income. Typically, that's what it is for renters. If you want to rent, you have to make 3 times the income mostly. That's what their requirements are. Well, same thing for lending. If you can have 30% of your gross income going towards your mortgage payment, that would be most ideal, and you won't be what we call house poor. And so if you can have a lender look at that and let you know, hey, where am I at with regards to my debt to income? Is it 30%, 35, 40, 45? That would let you know how much house you can afford and or how much house you're going to be paying every month with your income scenario. So it really depends on the debt, though, to answer your question. I have a borrower that just got done closing on a house a month ago, and under $100,000. I won't say give him exact income, but significantly under $100,000, and was able to buy a house in the Bay Area in the $400,000 range. Awesome. Just really depends on your debt to income scenario, and that was also with down payment assistance and coming in with less than $3 grand cash to close.
I think that some people think that the Bay Area is so expensive, prices are so crazy. How can I afford to live here?
Well, the prices are obviously the biggest common topic at most people's lunch breaks and what have you, but the rent's not slow down either.
Right.
And so you could either get to some point where you would fix your payment at 30 years fixed at a rate, and so that way you don't have to worry about inflation in your payment, or continue to go ahead and rent and have no type of benefit.
So what are closing costs?
Closing costs would be considered your lender fees and any other associated fees with regards to title and escrow. You'll also have some additional fees added into your estimated closing, but you have something called prepaids also. And prepaids all get added into your total cash to close that you have to come into escrow with, but that's really like a little extra savings account. So I don't really like to call that as closing costs, or like the true definition of a closing cost, because it's there to go ahead and help you pay for your upcoming property taxes that are due twice per year and your monthly house insurance for your hazards.
What about PITI?
PITI would be simply principal, interest, taxes, insurance. That would be your full payment. That's everything included when you get qualified. The lender would tell you, hey, here's that payment, here's what it would look like with everything included.
PMI.
PMI, private mortgage insurance, or MMI, monthly mortgage insurance. PMI is attached to any conventional type financing. Monthly mortgage insurance would be tied into any FHA type financing. The difference is with PMI, with the new laws in place with conventional financing, is anytime you put less than 20% down, this applies for conventional. So if you're putting 5%, 10%, 15% down, With conventional financing, you have to pay this monthly mortgage insurance. And then once you get 20% equity in your house by paying down your principal and the values of your house rising, you get to go ahead and have that removed automatically. You do not have to refinance anymore. FHA, you'll have that monthly mortgage insurance month after month, month after month. And even when you have 20% equity, you still have to refinance to get it removed off your mortgage.
How do buyers or borrowers out there prevent from having this insurance?
A couple of options. One, putting 20% down. Number one, fastest option, so you don't have to have it part of your payment. Two, is you can talk to your lender and ask them about a few different MI solutions. There's something called split mortgage insurance, where you can pay an additional upfront fee to get a smaller portion, so that way it falls off sooner and it's much cheaper monthly. Or you could do lender paid insurance. Totally different option as well that gets you a little bit higher interest rate, but it allows you to have no mortgage insurance at all. And depending on your tax situation, you want to talk to a CPA, you could obviously write off all your mortgage interest, where writing off monthly MI is questionable depending on your tax situation.
Where are interest rates going?
Where they're going, we hear another rate hike in the month of December. We hear another 3 more hikes in the year of 2019. So rates are moving up, and historically, we're still low. I know most folks would like to have purchases that are in the market. 4%, 3.5 are killer, numbers that we wish we could have today. It's just not feasible. If you can find that and you don't see any costs associated with discount points, I would take it and run. If you can't find that, I would come to reality and say, okay, rates are going up. It's only been sliding throughout the 2018 year, throughout the 2017 year. Get something locked down as soon as possible, so you don't have to pay more for the same type of house that you could buy now versus paying more for it in 2019 in the month of October.
Say they come to you and they do get pre-approved, and you give them an interest rate. How long does that interest rate last for them? How long does it get locked in for them?
Very good question. Also, this comes up sometimes as well in early parts of the transaction for buyers that are first-time buyers. When you get pre-approved, that does not mean your interest rate is locked. That's just on that day when that lender was running your numbers and they checked their pricing for your scenario with your FICO score, your down payment, your purchase price, they were able to see this is what's available in the market. But until you're under contract, every lender has the same policy that's in place. You cannot truly lock an interest rate until you have a property you're under contract on.
What would you say are some do's and don'ts, not only while in contract, but maybe even before you get into contract on a real estate transaction?
Do's and don'ts with regards to purchasing a home. Do's is do keep your job. Even if you're going to make more money, check with your lender first just to be 100% sure that that's okay. Do keep the money that you're using for your down payment in the same account. Try not to transfer back and forth. If you're getting a gift, do let your family or friends know that, hey, this is the account you want to send it to for me, and this is, just have it directly transferred. Don't give me cash. Do make all your payments on time. If you already have a mortgage and you're looking to sell and buy, right? Do pay your credit card, your car loan, everything on time. Nothing should change. Don't change jobs. Try not to transfer money back and forth. Anything that's considered 50% or larger than what you take home as a net paycheck is considered a large deposit. Mm-hmm. So if you're making net $10,000 a month and you have a $6,000 deposit, that's a large deposit. We need to know where it came from. Mm-hmm. So be careful with transferring funds. Do not open up any new trade lines. Do not open a new credit card. Do not get a new car. Even though you're trying to do everything at the same time, that right there I've seen it kill deals firsthand. I just bought the new BMW to go with the house. Well, that just hurts your purchasing ability. So you do not want to buy a new car. You do not want to co-sign for it with anybody. Try not to, my friend needs my help for co-signing on a car, and so we're on that car payment with them, and we just got to he's going to pay for it. He just got it last month. That'll kill your deal for sure. Just think of yourself as you're on timeout for at least 15, 20, 30 days, depending on how long you're going to close, until you get your keys in your hands. Then everything opens up. Then you can get your furniture.
Okay, well, seems like we covered
a lot. Yeah.
So, if you have any questions about getting pre-approved or where you stand or what you should do to get ready to buy a home with it, whether it be in the next 3 to 6 months or it be in the next 5 years, I think it's a great idea to talk to a lender now. We just want to give you the formula to get you prepared.
I would say that we are in an interesting time in our market. If you don't know where you're at now, it's hard to find out where you're going to go, right?
Episode 2 of Real Estate Rap Sesh. Yeah. I'm James Quintero.
Chris Ruiz, Supreme Lending.
So if you have any questions, please let us know, and we'll see you next time.
All right.
All right.